Good morning. Welcome to Forex Pro Chart's weekly analysis for the week beginning November the 21st, 2010. This week we are going to be looking at the AUD USD pair. We start by looking at the AUD on the monthly time period chart. As we look at the monthly chart, we can see that price has spiked above the outer edges of our trading field. The outer edges of our trading field are marked by these solid black lines, which indicate the previous monthly highs and monthly lows and indicate the range within which we're trading. As you can see here, the end of last month, price broke through the trading field, also went through this month, went up and actually formed a new resistance zone here, and then has spiked back down and is currently in this support zone, which is just below the outer edges of the trading field. The other things that we want to look at on the monthly charts, we always want to look and see which direction the trend is, and for the AUD, the trend is up. This is a long-term trend and just indicates for us in which way we are liable to see the strongest price moves, which would be in the direction of the trend. That's about all I want to talk about on the monthly chart. Let's go ahead and take a look at the weekly time period. Okay, looking at the weekly time frame chart, we can see our zones in a little bit more detail, and we can see price movement over the last several weeks. We see that price was moving very, very strongly up. This red candle, this is a volume indicator and indicates where volume changed. You can tell that because it's not outlined in black, so it indicates that we had a heavy volume here. Once price spiked through the outer edge of our trading field, it formed a doji here, which in traditional technical analysis is a reversal pattern, and we did in fact see price reverse and retrace a little bit before it turned around and moved back up through the outer edge of our trading field, moved up strongly in 1 week, moved all the way back down the next week. In the process, it formed this resistance zone here, and we also have formed a support zone just below this outer edge of our trading field. Now, some people will ask us, well, why, since price has moved through this, why is this still the outer edge of our trading field? Why have you not moved this up? Generally, we do not move these edges of our trading field until we have a feeling for which way price will go. Consistently long term. We could place it here, but if this week price just returns and moves back up, it kind of defeats the purpose. So at this point, we will be leaving this here. If price continues down this week, then we will likely be moving that up next week and have a new outer edge of our trading field. And then also we would have new weekly and monthly armpits most likely, and the weekly armpits and monthly armpits are designated by these thicker black dotted lines on the charts. The thickest one is the monthly, the medium one is the weekly. So we can see that last week price moved down back into the support zone, and we'll look at it in more detail, but you can see here that where the trend wall intersected with the 60-minute armpit was exactly where price hit, and we did see a bounce at that point. Now, looking at where price is liable to move this week, we would not be surprised to see, we would almost expect to see price return and move back up to this resistance zone. This zone begins at 1.0087, I believe. I apologize that those numbers are cut off on your chart. The 60-minute armpit is at about 1.0165. Coming down to this support zone, which is what price has just bounced out of now, we can see that the support zone began at 0.9821. The 60-minute armpit is at 0.9729, and there is a 5-minute armpit, which is right on top of the weekly dotted armpit at about 96.68. Now, should price continue back down and move through this zone, then we will likely see it move to this smaller support zone, which is right above the monthly armpit. And this zone, even though it does not have the drop base rally pattern on the weekly chart, because it is coincides with this monthly armpit, this should be an area where we should see a good little bounce, or possibly more of a retracement, or even price then bouncing here, continuing and then moving on up at this point. So even though we don't see right here what we like to see in terms of that drop base rally pattern, which say we see here drop base and rally. We like to see that pattern on the weekly charts, but again, because of the monthly armpit, this could be a good zone, and it's a smaller zone, so we have very little risk there. I wouldn't expect to see price move anywhere near these zones this coming week, so we won't discuss them at this time. We're going to go ahead and look at the daily chart next. Okay, so looking at the daily chart, we see where price reached this new high, moved down, and we formed our zone here, and moved all the way back down to this support zone. Now, this is the first time that we had revisited this zone. We see that we went straight down to the 60-minute armpit, which happened to intersect with this daily trend wall, and then price turned and moved back up. And we're going to look at that price action in more detail on the hourly chart to see exactly what happened during this time period. But in general, we can see that prices moved up. Now, at the last daily candle on Friday showed price moving down a little bit, but we would expect really to see price continue and move back up here. When it does, trading this 60-minute armpit at about 1.0166 would be where we would be placing a trade for a sell and expecting to see a bounce off of the armpit. And if you'd like to know exactly how we trade those armpits, you can subscribe to our services. We'll give you the website at the end. You can do a 1-week demo trial, and when you get our service, you get a complete written analysis on 10 pairs of currency, including the AUD USD, where we give you specific details on the upcoming zones, where the armpits are, and how we would trade those zones. Now, if price moves down, and those analyses are written as opposed to video format, so you can refer back to them more easily. Now, if price does move up here and then moves back down to this zone, or if it doesn't move all the way up and moves back down, if price moves back down and does not reach this zone, then we probably would not recommend trading this 60-minute armpit again because price has not moved enough. If price goes up here and then comes back down, this zone will be a little bit weaker because it has already been hit once. But if the price movement is right and we have the 3-to-1 ratio, then we could go ahead and take this 60-minute bounce again, probably one more time. And then as price moves down here, again, this zone begins at 93.98. The 60-minute armpit's at about 93.40, 93.50, and this area would be a very good area for a trade as well because of where it is in relation to the monthly armpit. Okay, let's take a look at the hourly and see what price did in the last week. We had a good trade on this pair last week. Okay, we're going to take a look here at what price did last week and the trade that we took. First of all, you see that when price hit the daily armpit here, it came within just a few pips and bounced, then came back over here, actually reached and spiked through the daily armpit and bounced again. As you know, we don't recommend trading those bounces off the daily armpit because the risk to reward ratio is not good enough. You have this whole risk here, and you see, you got a couple of bounces much less than that. And this is a less reliable trade than the 60-minute armpit. Some of our more aggressive traders do trade the daily armpit, but we don't recommend that as part of our signature trade setup. Anyway, but we do often see the bounces off of the daily armpits, and we expect to see those. So then price came down here, and right here it hit our 60-minute armpit. It bounced, and I believe, if I remember right, this was about between 50 and 60 pips that price bounced right here as soon as it hit the 60-minute armpit. Then you can see that that price came back to the 60-minute armpit after it had gone this 50 to 60 pips. And it spiked through, but only by a pip or two, right down to the level where it was here. And then it moved up and continued to move up. And the total bounce at the upper level here was 175 pips, which was a very, very nice trade. Now, as you know, if you've looked at our website at all, or if you've listened to our videos. Our signature trade setup is to take the bounce off of the first armpit, close the first portion of your trade actually when you hit 20 pips, immediately bring your stop to break even, and then wait to see if the other trades pan out. That's our most conservative trade setup. If you do bring your stop exactly to break even, then obviously you would have stopped out here, but you still would have had, depending on how you manage your trade and how you have the different portions set up. A lot of our traders set a limit of 50 pips on their second portion, because we very often see price go 50 to 75 pips before returning. And so in that case, you would have, before price returned, you would have seen the 20 pips and then the 50 pips. We also have other traders who are less conservative, who, instead of moving their stop exactly to break even, will put somewhat of a cushion, a 5 or 10 pip cushion. We always recommend that if you do that cushion, you don't make it any more on the remaining portions of your trade, that you make sure that those cushions, if price returns and stops you out, that the total stops on the remaining portions of your trade do not exceed the 20 pips or whatever your limit is here on the first portion of the trade. Our whole goal is to have very high probability trades. We try to take that 20 pips initially and secure that, lock that in place, and then protect that profit, and then if we get additional profit, great. We do have some traders who are willing to risk that first 20 pips of profit for the second and third movements, as long as the total trade does no worse than break them even. So that's a couple of different ways you can trade it, and in this case, those who have a 5 or 10 pip cushion on that trade would have seen the second or the third portion of their trade remain in, and as I said, we had about a 175, well, it was 175 pips total potential in this trade, depending on how you manage it and exactly where you took yourself out. A number of traders, since we have not gone back down to this area, a number of traders may still be in this trade waiting for price to continue back up, and their ultimate goal, of course, is to see price move up to the resistance zone up there and capture all of those pips. And they may very well do that this week. Okay, that concludes our discussion of the AUD this week. For more information or to subscribe to our full analysis and charting services, please go to www.forexprocharts.com, and you can take a look at our demo subscription for a week for just $1. And there you can go in and see the kinds of services and levels of service and the analyses and alerts that we provide to our members. Thanks a lot for visiting us. We'll see you next week.